Welcome to the Financial Independence Workshop, the first in a series of personal financial education workshops that will help you become financially independent. Who is Michael Evans and why should you listen to him? Well, I graduated from Loyola Marymount University in 1995 with a Bachelor's of Arts degree in economics focused on econometrics. I have 15 years of government management experience with a total of 25 years in operations and financial management experience. My last government job, I was the Chief Financial Officer for Santa Barbara County's Mental Health Department, where I managed a $100 million budget. I was an active real estate investor from 1997 to 2005. I was actually paid $15,000 to buy my first house. I've owned 3 houses with a combined equity of more than $350,000, and I've never used a penny of my own money. So what is financial independence? Let me give you my definition. It's having enough monthly cash flow to afford to live the way you want without having to work. Now, there's some keywords that I've highlighted. Monthly cash flow, afford, want, and work. So let's go through each of these keywords. So the first keyword is monthly cash flow. Basically, it's cash coming in minus cash going out. Now, you calculate cash flow over a specific time frame. It could be weekly, bi-weekly, monthly, quarterly, or even annually. And each of us has a personal cash flow statement. The second keyword is afford. And I define afford as being able to buy something and being able to meet that cost of something without unacceptable difficulty. Key phrase, unacceptable difficulty. Next is want, which is your desires beyond your needs, because every human being has a set of basic needs that need to be met in order to survive. But you have to be careful because you have to ask yourself, when do your wants become excessive and turn into greed? And the last keyword is work. Work is simply time and energy expended in order to receive a reward. Now, most of us work 40 hours or more per week, which is time and energy, in order to get a paycheck, which is our reward. But there's other types of work, such as when an athlete trains, expends time and energy in order to win at whatever they're competing, their reward. So let's talk about how you use the financial independence equation in order to calculate your financial independence number. And there's 3 parts of the equation. The first is the expense budget, which is based on your wants. Next is the cash flow return on investment, which is in line with your risk tolerance. And the last is income producing assets. And we'll go over each one of these parts. So here's the equation. Take your income producing assets multiplied by your cash flow return on investment equals your annual cash flow. Now, your annual cash flow has to be greater than your annual expense budget. Here's an example. If your income producing assets equal $1 million and your cash flow return on investment is 10%, $1 million times 10% equals $100,000 in cash flow per year. And if your annual expense budget is $75,000, then you generate enough cash flow to cover your expense budget. Now let's go into detail on each part of the financial independence equation. We'll start with the expense budget. It's the most important part of the equation because we control 100% of our expenses. We control how we spend money. Your income is not guaranteed. You can work for somebody else and they can lay you off, reduce your hours, or reduce your wage. And if you work for yourself, your sales may not come in at the volume that you expected them to. We always have the ability to decide how we spend money. And for this equation, your expense budget should be based on how you want to live, and it should be an annual amount. Next is your cash flow return on investment, what I call CROI. It's based on your risk tolerance. Your risk tolerance is how willing are you to risk losing all of your income producing assets that you've accumulated. I want you to rate that risk tolerance on a scale of 1 to 100, 1 being that you have 0 tolerance to lose any of your income producing assets, to where 100 is that you're willing to risk all of your income producing assets in order to make more money. Next, I want you to take that number and divide it by 5. So for example, if your risk tolerance is 50, where you're right in the middle, you take 50 divided by 5, and now your CROI, your cash flow return on investment, is 10%. The last thing is to calculate your income producing assets. And it's basically your expense budget divided by your CROI. So in this example, where we said our expense budget was $75,000 and we said that our CROI was 10%, we take 75,000 divided by 10% equals $750,000. That is your financial independence number. So now that you know what your destination is, the question is, how are you going to get there? You achieve your financial independence number by developing an asset accumulation plan or an app. Now, there are three parts of the asset accumulation plan. The first is investment. It's the annual amount that you consistently put toward this goal. The second is time, which is the number of years that you consistently put money towards this goal. And the third is your AROI, or your annual return on investment, which is how much you receive over the years on the money that you consistently put towards this goal. See a theme in the word consistently? Now let's go into more detail on each of these parts. So let's start with investment. We assume that you'll invest the same amount at the beginning of each year. Technically, you don't have to do it at the beginning of each year. All you have to do is be consistent and invest at least the same amount each year. Next is time. And as human beings, it's the most valuable resource that we have. You can't get it back, you can't make more of it, and you don't know when it's going to expire. It's also the standard by which money is valued. I can also guarantee you this. Once you become financially independent, you will extend your life. You will have more time with less stress in order to do the things that we were put here on earth to do, which is to have experiences. So let's talk about asset return on investment, AROI. It's different than cash flow ROI, which is CROI. AROI is applied to the annual investments in order to grow them into income-producing assets. AROI is applied to your annual investments while you're working. So your risk tolerance should be higher while you're working compared to when you're not working and you're relying upon your income-producing assets to generate cash flow. Therefore, your CROI should be more conservative than your AROI and should be lower than your AROI, right? Because protecting your cash flow from your income-producing assets is way more important than creating assets while you're working. So this is your asset accumulation plan equation worksheet. It's an Excel file. You see that it has 3 columns, investment, time, ROI, and 5 rows. Current investment balance, annual investment, number of years remaining, asset ROI, and income producing assets goal. The row at the bottom equals your financial independence number. As you can see from our example, it's set at $750,000. The top row is your current investment balance. So if you already have money saved, you would enter that information into the top row. If you don't, just leave it blank. The next 3 rows represent the 3 variables in the equation. As you change 2 of the variables, the 3rd variable in green will automatically change. So in the investment column, you can change the number of years remaining in the asset ROI and it will calculate the annual investment. In the time column, change the annual investment in the asset ROI and it will automatically calculate the number of years remaining. And in the ROI column, change the annual investment and number of years remaining and it will automatically calculate the asset ROI. So now let's take a look at what happens as we change different variables. So in this first example, the investment column is our starting point. We invest $6,366 per year for 20 years at an asset ROI of 15% in order to accumulate $750,000 in income producing assets. We see in the time column that when we double our annual investment and we keep the asset ROI the same, the number of years remaining goes from 20 to 15.46. We also see in the ROI column, when we double our annual investment and we keep the number of years the same, our asset ROI goes down from 15% to 9.45% in order to produce the same $750,000 goal. So what this shows is that when we double the annual investment amount, time is reduced by 23% and the ROI is reduced by 37% in order to achieve the same financial goal. Now in this example, the time column is our starting. You see that we started with $6,366 per year, 20 years, 15% in order to produce $750,000. In the investment column, when we cut the number of years in half from 20 to 10, keep the asset ROI the same at 15%, the annual investment jumps up to $32,120. And in the last ROI column, when we cut the years to 10, keep the annual investment the same, our asset ROI jumps up to 43.34%. This shows that when you cut the number of years you're investing in half, the amount that you have to invest each year increases by 400%, or your asset ROI increases by almost 200%. This shows that time is truly on your side, and the more time you have to invest, the easier it is to become financially independent. Now in this last scenario, we keep the ROI column the same. And what we do is we double the asset ROI. So in the investment column, we double the asset ROI from 15% to 20%, leave the number of years at 20, and you'll see that our annual investment decreases to only $915. In the next time column, when we double the asset ROI and we leave the annual investment at $6,366, the number of years decreases from 20 to 12.73. So what's the conclusion from this slide? When you double the asset ROI, you reduce the amount that you have to invest each year by 86%, and you can reduce the time by 36%. Now you might be saying, that's great, Mike, but how am I going to get a 15% annual ROI, let alone a 30% ROI? This is where I give you the tools to make these extreme double-digit annual returns using leverage, but that's for another workshop. So now, let me summarize. So financial independence is having enough monthly cash flow to afford to live the way you want without having to work. There are 4 key words from this definition that you need to know. The first is monthly cash flow, cash coming in minus cash going out. The second is afford, being able to meet the cost of something without unacceptable difficulty. The third is want, your desires beyond your needs but not to the extent of being greedy. And the fourth is work, the time and energy you expend in order to receive a reward. You have the financial independence number equation, which gives you your FIN. It's your income producing assets times your cash flow return on investment equals your annual cash flow, and that has to be greater than your expense budget. Now remember, your expense budget is based on how you want to live. In our example, our expense budget was $75,000. Your cash flow return on investment, or your CROI, is based on your risk tolerance of losing all of your income producing assets. It's based on a scale of 1 to 10. Take that number and divide it by 5, and that gives you your CROI. In our example, the risk tolerance was 50, therefore 50 divided by 5 equal to CROI of 10%. And the final part of the equation is calculating the income producing assets, which is simply the expense budget divided by CROI. So in our example, income producing assets equals $75,000 divided by 10%, which equals $750,000, and that's the FIN number in our example. Once you have your financial independence number and you know your destination, now you have to develop a plan to get there, and that's the asset accumulation plan, or the AAP. It has 3 parts. The first part is the investment. It's the annual amount that you consistently put towards this goal. Second is time. It's the number of years that you consistently put money towards the goal. And the last is your asset ROI, or your AROI. It's the annual return on investment that you receive over the years that you put money towards the goal. Now, we have a template that calculates and compares the effects of changing the 3 variables in order to reach your asset accumulation plan, which is your FIN number, your financial independence number. Just remember, there are an infinite number of paths in order to reach your financial independence number.